important topic, and that is the topic of the US Treasury yield curve. Now, the Treasury yield curve is an extremely powerful and accurate indicator of the onset of a recession. And basically, for mom and pop investors, what the Treasury yield curve is basically a chart that tells you how much interest you get by lending the government money. And in this case, the government that I'm talking about is the US Federal Reserve, the US government. Now the thing is, sometimes even a government needs money. They need money, all right? And when they need money, they issue what I call IOUs to its citizens. And these IOUs are also known as bonds. Now, there are three types of bonds. You just have to remember them as BNB. Bonds, notes, and bills. So treasury bonds, treasury notes, and treasury bills. The reason for the different naming is very simple. It's because of different time periods. If you lend the government money for 1 month to about a year, it's called a treasury bond. If you lend the government money anywhere between 1 to 10 years, it's called a treasury note. If you lend the government money between 10 to 30 years, it's known as a treasury bill. So, like any other loan, the longer you lend the government money for, the better the interest rate you will get, right? Because when you lend the government money, or when you lend anybody money for an extended period of time, you are sacrificing your short-term liquidity. And in the finance world, in the financial world, you need to be compensated for that. You need to be compensated for sacrificing short-term liquidity. So usually, a treasury bond will have less interest rate than a treasury bill. A treasury note will also have better interest rates than a treasury bond. All right? So, now, why am I saying all this? I'm saying all this because there is a very good reason for you to know the yield curve. All right? The yield, Y-I-E-L-D, basically refers to the interest rate. Yield equals interest rate. Simple as that. It is not a complicated term. It is not difficult to learn. Yield is the amount of interest you get. A curve is just the shape of the chart. It's just the shape of the chart. Okay? So I recommend you guys a website. It's called gurufocus.com. How do you get here? Simple. Just go to Google and then type in US Treasury yield curve. The moment you type that in, scroll down, this one, yield curve -gurufocus.com. You click on it. It takes you to the US Treasury yield curve. All right. So you can see here, the 1 month yield is 0.1%. This is the interest rate that you get. 1 year yield is 0.15%. 2 years 0.2%, 10 year 0.63%, 30 years is 1.23%. Now the rates can move up and down. I'm not going to go into that. Going up and down has its own significance as well, but today's video is not for that. Now instead, we're going to look at the shape of the curve. Now, as of now, we have an upward sloping curve. So it means, what does that mean? It means that it follows the logic whereby you get more interest rates for a longer term loan. So if you lend the government money for an extended period of time, you get more interest rates. Now, what happens when this curve inverts? Meaning, instead of going up like that, it is actually going up like that. Okay, that means instead of like that, it goes up like that. Okay, so that is what we call inverted yield curve. Now, for inverted yield curve, what happens is very simple. All right, let me just Google for you inverted yield curve and how it looks like. So this is what I meant by inverted yield curve. It goes like that. Okay, so if you compare this to this, you can see that it's opposite. It's opposite of each other. That's what I mean by inverted. Okay, so when it's an inverted yield curve, which is this right here, all right. When is it? This one, all right. When it's an inverted yield curve, what it means is that it signals the onset of a recession when the yield curve starts to invert. In other words, when the government is offering better interest rates for short-term loan compared to long-term loan, it means two things. Number one, it means that the government wants to stimulate spending. They want to make you spend money, so they are giving you better interest rates, if you go for a short-term loan. Number two, it means that the government doesn't want you to store your cash away with them for a long period of time. They want you to use your cash right there, right then. Number three, it means that the government, the US government, is not confident it can give you such good interest rates for the next 10 years because it's expecting an economic contraction. All right, it is expecting a severe economic contraction. Economic contraction means that the entire country's GDP, gross domestic product, which is basically the equivalent to the gross revenue of a company, similar, not the same, but similar, and is expecting a contraction in the GDP, which will lead to a direct contraction in terms of government revenue. So they do not have the confidence to give you high interest rates in the long term. So that's why analysts say that an inverted yield curve usually means the onset of a recession. Now, if you go back to the website, you can see that it says here, an inverted yield curve has predicted the past 7 recessions. So the thing is, for most of us, we only know 2 key recessions, 2001 and 2008. So why does it say 7 here? Now, you must understand that recessions have a lot of definitions. All right, there's a technical requirement for a recession. All right, it's a long list of criterion. All right, and that's why the US has undergone 7 and not 2 recessions. Those 2 recessions are the severe ones. They are a crisis. Those 2 are a crisis. But other than that, the US has undergone 5 other recessions as well. According to the technical definition of a recession by the Federal Reserve. So you can see that it says here, all right, the 7 recessions, first one, happened in 1970. The next one happened in 1975. The third one happened in 1982. Then 1990. Then there's one in 2001, the one that we know. And then there's one in 2008, the one that we know as well. So an inverted yield curve has predicted the past 7 recessions. Now, of course, you see this curve right here. Some of it is above the red line, some of it is below the red line. Now, this right here has nothing to do with the yield curve. This is basically just an average of all the interest rates of what they call the coupon rate that is given for the government bonds. So below the red line is when it's negative. So if you want to buy government bonds, instead of the government paying you money for it, you are paying the government money. Okay? Only when it's above zero, all right, then it makes perfect sense for you to buy government bonds because they will pay you money and you don't have to pay them money. All right? So usually the onset of a recession is when the yield curve starts to invert. So what does that mean? Like I said, it refers to this chart here. So this is the first point. So in other words, if now we are at a pretty high point for the 30 years bond, if you start to see that the percentage or the treasury yield percentage for 1 month, 3 months starts to get higher and higher, and the treasury yield rate for the 10, 20, and 30 years bonds or bills, treasury bills, start to get lesser and lesser, that is when you need to start looking at the US Treasury yield curve, because that could signal the start of a technical recession. Now, whether that technical recession becomes a monster, well, it depends. It depends on the cause of the recession and the severity of the recession. But the US Treasury yield curve is an important indicator. Now, usually this is used for the debt markets. I'm an equity markets guy. I'm not a debt market guy. But still, this offers a very important insight on how well the economy is doing or how well the government expects the economy to do. So, and the government has the overall foresight and the overall oversight on the entire economy. So this says a lot about what's going to happen to the economy. That's why as equity investors, as an equities market specialist, we also need to know the US Treasury yield curve. All right, that's all for me today. Thank you very much.